Hello everyone, welcome to today's webinar hosted by PAC Assets Management. My name is Caroline Emmanuel and I'll be your moderator for today. On behalf of PAC Assets Management, thank you for taking the time to be with us here today. The financial market, as we all know, continues to evolve, presenting both opportunities and challenges for investors. Today's section has been carefully designed to provide valuable insights and into the current market landscape, review investment performances so far this year, discuss strategies and that can help position your portfolio for the opportunities and risks that might arise in the months ahead. So whether you are an existing investor or a new investor looking to gain better understanding of today's investment environment, we believe this session will provide practical knowledge to support your financial goals. We are still waiting for your reactions and also we want to know where you are joining us from. So today's webinar promises to be insightful, practical, and timely as we discuss how investors can better, position their portfolios for the rest of the year. But before we dive right into the main theme for today, let's have a quick introduction of our speakers. So our first, we have two speakers here, and I'll start by introducing the Managing Director of PAC Assets Management, Mr. Bamidele Ige. He's also an associate of the Chartered Accountants of Nigeria. He has more than 13 years working experience in assets investment management, having worked as an investor, investment advisor, an equity analyst, a credit analyst, a fixed income trader, a portfolio manager, and a client relationship manager. His tireless efforts have been seen, have set up and his tireless efforts have seen the setup and the licensing of PAC asset management over the years. Can we please celebrate our managing director with a virtual round of applause?
Yeah, Caroline, thank you. And this is a special welcome to everyone who is participating in this. We're happy to have you here. And we believe that the session you're about to witness would help to guide your investment decisions for the remaining part of the year. As you know, certain things, certain developments have occurred in the local and the global markets. You have the US-Iran hostilities continuing. And of course, yesterday we have our CBN maintaining status quo on MPR. We believe these will be defining factors of what happens in the rest of the year. And I believe that Afam is going to give us a great deal of insight as to how we should invest. Thank you very much.
Thank you very much, Mr. Bamidele. I'll go ahead to introduce our second speaker, Mr. Afamuefuna Chukwurah. He's an investment research and financial advisory professional with over 12 years of experience across Nigeria's financial services industry. He currently serves as the deputy head of PAC Research, where he provides strategic leadership in macroeconomic research and sector analysis, policy evaluation, and investment intelligence to support executive and decision making. Prior to his role as the deputy head of PAC Research, he held senior research advisory positions at leading investment banking, securities, asset management, real estate, and financial advisory firms. Mr. Afamuefuna has advised both corporate and institutional clients on strategic investments, infrastructure projects, mergers and acquisitions, and business expansions initiative. Can we give a virtual round of applause for Mr. Afamuefuna Chukwurah? So Mr. Afamuefuna will be taking us through today's topic and sharing practical strategies that can help investors reposition their portfolios. Before we dive right in, I'd like you to know that the chat box is not working at the moment, but we are working to see it come up so that we can see your comments and know how you are doing so far. But before we dive right in, I would like us to remember some housekeeping rules. Number one is please ensure your mics are muted throughout the session, and questions should be drop in the Q&A session or the chat box. I will hand over to Mr. Afamuefuna Chukwurah to proceed with his presentation. Over to you, Mr. Afam.
All right. Thank you very much, Caroline, for that.
You're
Good
welcome.
morning, all, or good afternoon, rather, all, and welcome to this fully packed and loaded webinar session, which is going to help us navigate the rest half of 2026. Okay, so let me just wait for my slides. Okay. So the theme basically is, are you positioned for the rest of the year? Next slide, please. So as we enter the second half of 2026, opportunities still exist, but the environment has become more demanding. We're seeing global growth is still continuing. We're observing that Nigeria's inflation has slightly moderated and local yields still remain attractive. But yet, what is very important is that geopolitical risk and expensive capital and changing valuations mean that yesterday's portfolio may no longer be suitable for tomorrow's conditions. So our central view at PSC Research is that in the second half of 2026, we expect that activities there will reward deliberate allocation and not just passive exposure to various assets. So our objective basically is to combine four functions: income, growth, protection, and liquidity, which is what will form the bane of how we're going to invest or channel our investments through the second half of 2026. Next slide. Next one, please. Next. Yeah. So like we said, the first half of 2026 did not produce a global recession, of course, despite the whole geopolitical upheavals. But what happened was that it changed the balance. IMF projected global growth to be about a slight decline from its 3.1 projection earlier in the year. And this will be majorly driven by technology investments and services, basically. While we're still observing that conflict and energy disruptions and weaker manufacturing will also serve as or constitute constraints across markets. Inflation also became less predictable. Global inflation is projected at 4.7%. This is an upward review from the earlier projection of 4.0%. But in Nigeria, our picture improved, but it remains conditional basically because real GDP grew in Q1 2026 by 3.89%. And headline inflation, as we recently was reported, moderated to about 15.91% for June 2026. But what is more instructive basically in that inflation number is that food inflation remains sticky upwards at 17.52%, while core inflation still sticky upwards, but we saw some little signs of relief at 15.92. But then, as Mr. Bamidele had pointed out to, the MPC retained its monetary policy rates, although still highly restrictive at 26.5%. So what this basically means is that growth is still available and income remains attractive, but the margins for passive positioning has narrowed. investors must now distinguish nominal return from real return, high yield from sustainable yield, and lastly, they must distinguish between broad exposure from deliberate selection. Next slide. How did the major asset classes perform? In H1, we produced the investment space produced two clear winners, but for different reasons basically. In the equities market, we saw that the LGX ASI gained approximately 47.14%. That's after coming down from a peak of 62% sometime in May 2026. But ultimately, the first half ended at 47.14%. And this was largely supported by domestic liquidity and a revaluation or repricing of large cap assets. Then, secondly, we saw that treasury bills also won in terms of income line. We saw that yields maintained that mid to high teens with a strong combination of carry, liquidity, and low duration. That's basically people opted more for money market instruments and Nigerian treasury bills during the period. But we also observed that if inflation, as we've seen the pattern, continues to fall, and monetary easing becomes credible because we're actually in the phase of easing. We've moved up from the phase of strict tightening to a phase of easing, although it's intermittent because the volatility we're seeing. But we can credibly say that largely from entering from Q4 2026, 2025 rather, we're in the phase of expectant easing. Next slide, please. So 5 forces that will determine where capital moves in H2. First, the price of new capital. Although we observe that even though some central banks globally reduce rates, the return to ultra cheap money is unlikely. Income assets remain competitive while leveraged businesses face a higher hurdle, of course, because of the high cost of financing we're seeing currently. Secondly, artificial intelligence is largely becoming an infrastructure. We've seen from reports from UNCTAD that there's a total of $270 billion in data center investments in 2025. So we expect that at the end of this year as well, when the data comes out, we're projecting at least some double-digit growth in that number as well, which definitely will trickle down into some supply chain in the Nigerian economy. And thirdly, geopolitics now is largely becoming a very important macroeconomic variable because it now transmits directly into portfolios through oil, freight, food prices, and ultimately inflation, which has a direct impact on interest rate then. So investors should treat it as an economic mechanism, not just simply as a headline risk. Then fourth, emerging markets are being repriced. Countries are increasingly judged by policy credibility, currency stability, liquidity, and ability to generate real returns. Then lastly, commodities have become strategic. For Nigeria, commodity shocks create opportunities and costs. We're seeing that higher oil supports exports, goes into domestic inflation, which also trickles or informs the decision of the MPC to keep or retain rates sticky upwards. So ultimately, our conclusion is that H2 2026 is going to reward resilience over speculation. We would like to be looking more or focus more on sustainable income, productivity exposure, and also credible policy frameworks. Next slide, please. So a portfolio should change. Is your portfolio still fit for purpose? These are questions that every investor should be asking at this point in time. We've seen a lot of volatility spiraling from different angles, both domestic and foreign, non-domestic. So you examine your portfolio. When should you change your portfolio? Basically, um, the rule of thumb basically is that circumstances of markets change. But what we do is there's this acronym we try to use to examine or analyze if our portfolio still meets our earlier objectives as at when it was due. We call it the PAC fit test. Firstly, we look at the purpose. What financial goal must this portfolio achieve? Then we look at allocation. Does the mix of assets reflect the required return? And also the investor's capacity for loss. What are your risk tolerance as it were, which informs your mix of assets? Also, look at C, concentration. Is too much wealth tied into one company or one sector or even one currency or country, geographical spread as it were. Then funding as well. Is your portfolio able to fund emergency needs or obligation without forced selling some of your assets? Then you also consider inflation. Inflation is a very key variable we need to consider because that's what differentiates between our nominal and real return. Then time as well. Maturities to investment must match when our money is expected to be used or put into use. For instance, when you see that inflation is currently at 15.91% and your portfolio is returning 10%, yeah, you can say it's a positive return. But when you discount your costs, inflation firstly, financing costs, and also other costs attached to establishing that portfolio, you see that ultimately you're making a net negative return, especially in Naira terms. Then what should you now do? When you observe these things, you should have at least four key actions or four decisions which should follow your portfolio review. You either retain the portfolio if it's meeting your objectives, as it were, or you rebalance. If you see that your asset mix is not favoring your current objectives, you can rebalance, or you even entirely replace the assets. You have different asset classes already in your portfolio, and you see that one keeps giving you negative returns, drawing down the bottom line of that portfolio. Of course, if the projection is still pessimistic, then you have to replace that asset to buffer up the performance of your portfolio. Or ultimately, you could also redirect, change your objectives, as it were, based on the current macroeconomic realities. Next slide, please. So good investments basically can still produce poor outcomes when behavior takes control. One first mistake people make is to chase recent returns. Like we've seen, the NGX already has done 47.14% in the first half of the year. Is there a guarantee that it's going to repeat that performance? That's on a broad level. Even in a in a stock by stock basis, some stocks have exceeded 100%. If you enter that or take a position in such stock, is there a guarantee that it's going to return that? That's where you need to drill further. And these are behaviors that people make mistake whenever they are rebalancing their portfolio. Secondly, waiting for the perfect time. Markets often begin to recover before economic conditions are comfortable. So we need to have a deployment plan than to keep waiting and hesitating before the moves or the waves have passed. Then we start making moves. Then thirdly, false diversification. For instance, you could own several bank stocks, Zenith, GT, or FCMB. Yeah, you could call it diversification, but don't forget your sector concentration as well is in the banking sector. So if there are policies that or even regulation that may serve as a negative headwinds against performance of that sector, then of course you know that your portfolio is um, largely exposed to such volatilities. Then the fourth is ignoring inflation. We've consistently emphasized the need to look at the real return rates and not nominal return rates. And one baseline is to consider what inflation is doing and see how our portfolios can outperform inflation, as it were. Then lastly, we're seeing emotional investing as well is one of those key behaviors that can destroy your portfolio value in H2 2026. Next slide, please. So where should our investors position now? Coming from our conversation so far, we said that we are looking at 4 cardinal points to inform the decision of our portfolio construction. The first is to look at income. Income. What are those assets that generate largely guaranteed income, guaranteed in quote here? We'll look at fixed income securities or assets, treasury bills, money market funds that can pay the portfolio while yields are currently elevated. We can earn some income from that as well. Then another cardinal point to consider, the second one is growth. This is where we look at selective equities. We look at fundamentally strong stocks that have the potential of delivering value. And mind you, because we've had an extensive bullish run in H1 2026, we might want to delve further and look at the quality of earnings of the stocks we are currently considering for H2 2026, and also look at their valuation and pricing. Timing also matters. With all these things, we believe that we could make solid choices with a focus on growth in mind. Then the third cardinal point to consider is protection. Yeah, with every asset, we must, just like in real life, we must have something like an insurance policy. Although our choices based on income and growth are fundamentally based, there is no gainsaying, as we've seen, that sometimes unplanned events of volatility might just come and erode our projections. So we could see that if we have some form of protection, likely in US assets or USD denominated assets, yeah, we could basically fine tune our portfolio to ensure that we are not overly exposed to all forms of risk, be it internal currency or even foreign risk, as it were. Then lastly, we look at liquidity as a very important cardinal point. Yeah, of course, every PM will always ask you to make sure that there's a provision for opportunities in the market. There should always be a provision to take advantage of opportunities that come up quickly and earn some quick returns in the market. That's why your portfolio should always be designed with liquidity in mind. But as we proceed on the presentation, we'll see. Okay, on the right hand of your screen, we see something like an illustrated weight we profile for you to be able to accommodate these 4 cardinal points. At least we're projecting that if your portfolio has a minimum of 15% liquidity, then you will be good to go. Of course, this definitely will also depend on the kind of investor and your risk tolerance as well. But optimally, we expect that this could be a guidance to what your portfolio should look like in terms of exposure. With these 4 cardinal points, I repeat them again. You focus on income, you look at growth, you look at how to protect the overall position of the portfolio, then you also look at liquidity. Next slide, please. So our highest relative conviction remains fixed income. Currently, we're at an era of elevated yields, and we expect that this is going to continue to support current income. although we are seeing credible signs of disinflation, but we'll keep observing to see the role this price volatility is going to play in domestic economy and the response the MPC is going to have as we proceed further. Next slide, please. So when we look, sorry. So when we look at this on your screen here is like a risk map where the most important risks are those that can affect several asset classes simultaneously. We'll look at persistent inflation. Persistent inflation, when you look at that score there, you see it has a very high risk score because once there is high price volatility, we see that it affects every other thing, be it in terms of long duration bonds valuation, be it in terms of interest rate direction, or even currency risks as well. The flow of currency stabilization, basically. Then on our risk map as well, we have geopolitical tension. I mean, everyone has felt the heat so far in the economy, and we it's not a new thing for us to start analyzing. Basically, we've seen how volatility in oil prices has trickled down into domestic PMS prices, into food prices, and ultimately into sticky upwards inflation. Yeah, then as we go on the ladder, we rank various parameters in terms of risk. So when you put all this in consideration, we are proposing that you use our PAC Shield approach to guide your portfolio. And by PAC Shield, what we mean there basically is to spread your risk. S is for spreading your risk across various independent drivers. That's basic PM approach to portfolio management. Then we'll also see how to hedge our actual liabilities. Then next step is to insist on quality. Then largely we might want to extend our maturities, but we need to be very careful with this because as we are seeing elevated yields, we know it's going to favor longer dated fixed income assets as it were, because whatever it is that is going to make rates or the monetary policy committee start bringing down rates, then we know there's going to be a bullish run on longer dated assets. So but we might want to still be very careful and not be too optimistic on that line. Then, as we always say, we maintain liquidity and also apply discipline through rebalancing activity. And mind you, when we are doing all this, the objective is not to eliminate uncertainty, but is to prevent one shock or risk parameter from determining the outcome of our entire portfolio. Next slide, please. So investors should not wait for perfect conditions. Firstly, we need to define the purpose of the portfolio and the cash flows it must fund. Then second, we need to diagnose the current allocation because we've seen strong H1 performance in the equities and also another asset much larger than intended. Then thirdly, we need to correct the gaps of rebalancing, replacing unsuitable holdings and improving diversification. Then fourthly, we need to upgrade the quality of the portfolio by prioritizing sustainable income. Then lastly, we need to implement, basically, and track our strategies. Over time, we review our dates and also effect triggers as it were, so that it will always prompt us on where we need to rebalance or reassess our portfolios. Next slide, please. So, conclusions for H2 2026. We need to always bear in mind that first, the investment landscape has changed. So forward-looking assumptions matter more than H1 2026 performance alone. Then secondly, portfolio reviews must be regular because markets and personal circumstances change. Then third, diversification remains essential, but it must combine independent return drivers. Fourth, opportunities still exist, in the fixed income space, also in selected equities, and then in strategic foreign currency exposure. Then lastly, we need to position for wealth and not just the headlines. So ultimately, the strongest portfolio is not the one that predicts every market movement. It is the one that can fund its purpose across different market conditions. All right, next slide, please. All right, thank you very much. That's all from our end at PSC Research. Caroline, okay.
Thank you very much, Mr. Afamuefuna. Please let's give our first speaker a virtual round of applause. Our reaction button is working now. This was quite an insightful and practical presentation, and I'm sure our notes are full. Mine is quite full, and I have a lot of questions. I can't wait for the Q&A session to commence. So that we don't waste much time, let's welcome our second speaker, the Managing Director of PAC Asset Management, Mr. Bamidele Ige, as he comes up to throw more light from another perspective on today's presentation. Thank you very much, Mr. Bamidele. Over to you, sir.
Yes, good morning, or good afternoon, everyone, and welcome to this webinar. I will speak briefly because the theme of our presentations resonate between what I have to present and what Afam has just presented. It resonates. You would you will see, I mean, as I go into the presentation, you will see the similarities in what we're talking about, having looked at what is happening in the global environment as well as the local environment. So I'm having a short presentation that talks about the position for the rest of 2026, Nigeria and global market review, and the succinct guidance for half-to asset allocation. So, I mean, what have we seen? There's been some disinflation in half one, but rates and FX remain an anchor. Those are major concerns that that are issues for us now. You may have noticed that with what is going on in the on the global scene, we expect some headwinds ahead in terms of oil pricing and maybe some exchange rate movements. And of course, that means we can also expect some form of inflation arising from rising pump prices of fuel. So what changed in half one? You see that inflation eased a bit to about 15.91%, but food inflation remains high. The policy rate at 26.5 keeps cash yields attractive. Again, that just speaks to the fact that we've been observing in the market that fixed income yields are looking better. And of course, you've seen the effect on the equities market, people taking profit and going ahead to invest in fixed income markets. So again, you will see based on based on these factors, that there's a lot more interest in the fixed income market this period because of the better yields. Of course, the FX risk remains and may even become more obvious as we go on in the remaining part of the year because of what is happening again in the Middle East. And as we have observed, the NGX rallied strongly in the first half, and gains are concentrated and valuation is now sensitive. Sorry. So, what are the implications for clients? There are different portfolios types that we offer. For the money market fund, there's core liquidity and yield. And of course, you find that if yields are increasing in the fixed income market, there's a benefit for clients on the money market. The same thing applies to the fixed income fund, where you can lock in your income, lock in income cautiously. And of course, you can hedge with the Eurobond fund. These are things, concerns that have been talked about in the previous presentation, where there's specific emphasis on income, on growth, on protection, and on liquidity. Of course, money market fund will offer you that liquidity. The equity fund, of course, will offer you growth opportunities, especially where you want to really earn some capital gains. There are still opportunities there to pursue. And then, of course, on the Eurobond fund front, it serves as a hedge for you to protect your portfolios, to protect your earning power. So on the global scene, what we have, equities are supported by tech, but oil and policy are risk flags. Oil and policy remain as risk flags and have two global signals. What we see, MSCI World is at 9.9% year to date, and emerging markets is at 24% to June 30. The Fed funds range held at between 3.5 to 3.75. Brent is near 86. This may have changed now because of what is going on in the Middle East. And it returned to June 30. We see all of those data there. And of course, the portfolio stance is keep USD exposure, maintain your USD exposure, diversify beyond one theme, and avoid overpaying after a strong rally. The stock market in Nigeria has seen a strong rally, and we need to be careful when we're investing there. So a simple have-to positioning framework built around 4 portfolio goals. Number 1, liquidity, and you see the products we offer there is Taka Money Market Fund. There are other products you need to speak to us on that. And then build around income, where you can consistently get some flows. Taka Fixed Income can offer you that. In fact, Money Market Fund can offer you that as well because of quarterly distribution. Build around growth, that is where Packham Equity Fund comes in and the Balance Fund comes in. I mean, the Balance Fund sorts of has an advantage in that it participates in two sides of the market, the equities and the fixed income. And when one is not doing well, the other can cover. So consider that as well as hedge. By all means, hedge, because we think that the FX risks remain. So the rule of thumb is match asset mix to time horizon, not market noise. When you design your portfolio, make sure that you're focused on what you have designed in your portfolio. Sometimes you hear a lot of market noise in the market. You shouldn't make that a determinant of your strategy that you have carved out by yourself, because breaking a strategy might actually have severe implications. So our playbook, our recommended playbook for the rest of the year, we have 5 products that we have listed here: Balance Fund for diversification, Money Market Fund for liquidity, Fixed Income Fund for income, and Equity Fund for growth, and the Eurobond Fund for portfolio diversification. So how can clients position? You can be a conservative investor, a balanced investor, or someone who desires growth. You can use any of these portfolio mutual funds that we offer to achieve your desired portfolio strategy. So bottom line is for half to 2026, rewards disciplined diversification. Just know that disciplined diversification, that's diversification that is planned, that is focused. You should be careful with concentration in certain markets so as not to get bitten. At this point, I'd say thank you very much for listening in. We can take questions and answers now. And I'll return the mic to Caroline. Thank you.
Thank you very much, Mr. Bamidele. Please let's give our second speaker a virtual round of applause. This was quite an insightful session. I can see a lot of questions in the Q&A session. Because of time, we might not be able to take every question, but we will proceed with some of the questions. I also want to use the opportunity to say welcome again for joining us on today's webinar. I'm sure you have you've learned a lot today about reviewing your portfolio for the rest of the year. Okay, our first question goes to our first speaker, that's Mr. Afamuefuna. So the question says, good afternoon, and thank you for the insightful session. I have a quick question for the first speaker. Okay, so it's saying, as how has Nigeria deflated inflation so far? Mr. Afam, please can you react if you can hear me? Can react with
Okay,
a
sorry.
thumbs up. Oh,
Okay,
okay.
I can hear you, Caroline. Can you just come again with your question, please? Network.
Okay, so the question says, how has Nigeria deflated inflation? That's the first question I have here, and it's directed to you.
Oh, okay. Thank you very much for that question. But wouldn't say that Nigeria has defeated inflation per se. But what we can say is that the inflation has moderated, basically. Firstly, the pointers to look at are the volatile components of inflation. Then you also look at the core component of inflation. So core inflation in the last inflation print declined slightly from regions of about 16.8% to currently about 15.92%. While we saw that major volatile components like food inflation increased from about 16.9% thereabout to about 17.7%. So what that tells us is that broad-based in the economy, the underlying price level are still stabilizing lower. But because of these more volatile components, of course, for obvious reasons, due to recent oil price hikes, which are trickled into transportation costs, majorly directly affects our food prices. It has left these prices upwards. So we are in a phase whereby we are affected majorly by price volatility. So we need to be quite cautious. That's why you see the CBN has adopted a wait and watch approach. So maybe after this phase, we might now properly see the impact of a normalized economy in, or the impact is going to have on core inflation as it were. Then if we see that the inflation rate sustainably continues on a decline, yeah, then we can properly say that we have measurable gains in inflation. But right now, we can't categorically use the term defeated inflation in an absolute sense. Thank you.
Very much, Mr. Afam. I believe the person who asked that question has gotten, the feedback they needed. Please, if that was you, kindly react, with the reaction button by giving us a thumbs up or a clapping emoji. Okay, Mr. Afam, there's another question for you here. So the question says, with the MPR retained at 26.5% and the current macroeconomic outlook, which sectors of the Nigerian economy do you believe offers the most attractive investment opportunities in the second half of the year? Would you like me to take that again?
Yeah, please, can you take it again, please?
Okay, I said with the MPR retained at 26.5% and the current macroeconomic outlook, which sectors of the Nigerian economy do you believe offer the most attractive investment opportunities in the second half of 2026? Did you get the question now?
Okay. Okay, yeah, yeah, sure. I got your question. So basically, the reference to the NPR speaks to elevated interest rates, which indirectly means higher cost of financing. But giving a background to that, we've been at this level, will I say, somewhat in from Q1 2026. But in the same period, we saw that the GDP report from the NBS showed us that manufacturing sector grew, I think, by about 3.9%, which is a sector that is largely exposed to high cost of financing as it were. But then again, we saw that GDP is currently being supported by services sector, which has contributed about 51% to entire GDP, and also majorly the ICT sector. This has experienced largely somewhat double-digit growth. We can deduce from such is that the technology space, the ICT space or exposed firms, we will say constitute somewhat an inflation protection, as it were, from the adverse effects of inflation and also the NPR or cost of financing, as it were. So, given that contribution, which has been continually for the past like 4 years, the services sector has been contributing largely to GDP. We believe that we can play in that sector and also ultimately position ourselves in the technology sub-sector, as it were, also. Then we also look at the agricultural sector, which has contributed about 20% to GDP, and the federal government's drive to enhance activities in that sector. So naturally, we need to follow where the money is going to. Then that's also a sector we need to also put in mind and consideration, because that's very integral to solving our food inflation problem, which is not going to be solved by monetary policy alone. So if we see that fiscal policy is directed towards that direction, then of course investors should also follow where the money is headed to. So I believe those should give us clearer perspective as to where we should optimally follow or guide our investors' direction in H2 2026. Thank you, Caroline.
Oh, thank you very much, Mr. Afan. We have the chats, the Q&A session is, it's building up. We have interesting questions piling up here. And this next question goes to Mr. Mr. Bamidele. So the question says, please, what is the significance of Access Bank sale of minority shares in Ghana to Nigerian investors? Did you get that, sir? Or do you want me to
Please
take
take
it
the
again?
question one more time.
Okay, so the question says, please, what is the significance of Access Bank sale of minority shares in Ghana to Nigerian investors?
Okay, good. First of all, we have to consider what resulted or what is leading to the sale of minority shares in Access Bank Ghana and probably maybe in other markets. It's a regulatory requirement for the bank to reduce exposure to other markets, to within a sizable portion of its shareholders' funds. So that is a requirement by the CBN, which is the reason why the bank could not pay dividend, for the period ended 2025, because they needed to comply before they're able to pay dividend. Again, what you find is that, look, this is a risk management measure from our own CBN, restricting how far banks are exposed to other markets. What do we expect as an outcome, or some form of liquidity in the hand of the banks from whatever they realize from the sale? Puts the position for future dividend payment. And of course, once they're able to resume dividend payment, what you find is that the share price of that bank will begin to move in tandem with its peers in the industry. What you find now is other large banks which form the Fugas group. They've all, shot up in share price value, but we haven't seen the same kind of trajectory with Access Bank. But with once they resume, it is almost certain that they're going to try to catch up with. The share price will catch up with those of the other banks. So that presents an opportunity that one can begin to look at right now. So I think I'll keep it that simple. Thank you.
Thank you very much, Mr. Bamidele. Because of time, we won't be able to take all the questions, but we'll take two more questions. And I believe our audiences are getting the desired answers. Mr. Afam, the next question goes to you. So the question says, could you please share more light on it? For example, provide are there products or tools out there that provide such cover? So I think this is like a continuation to the first question you took, Mr. Afam. Do you want me to take that again?
Yeah,
Okay,
yes,
so
please take it again. The question is, it seems not
okay, so
complete a little bit.
all right. So please, I would like to know more about the investment protection. The first speaker mentioned passively. So could you please share more light on it and how it works? For example, are there products or tools out there that provide such cover?
Okay, that's basically a PM question, but we could just say that in terms of portfolio protection, basically, it speaks to the kind of assets you put in that portfolio. Yeah, ultimately, you can do portfolio insurance. Yeah, that's by the way. I think Mr. Bamidele can speak to us largely on that. But we could also get more, like, for instance, to hedge the bottom line of your portfolio performance, to protect it. You could get guaranteed incomes from treasury bills, depending on the weight allocated to such assets, as it were. So that could offer some form of protection to your portfolio, should in case the sorry,
Yes,
you're raising
I
your
was
hand,
trying
sorry.
to. Yes, I was trying to share some points on portfolio protection. So what we have discussed about portfolio protection, look at it from 2 points of view. First of all, the point of view of diversification. Um, if you're not absolutely sure, then you should not be concentrated in a particular asset class or in a particular investment. That's one way to look at it. The other way to look at it is to look at it from a currency perspective. Um, we if you look at what is going on in the FX market, you want to have some form of FX protection to your purchasing power. So, of course, it is recommended that you have some allocation to FX so that in case there is some headwinds for the local currency, you have preserved some of your value, having invested in a foreign currency. Those are the kind of protections that we're suggesting. As Afam said, you can buy portfolio insurance. I'm not sure exactly now who sells that kind of insurance product. in the local market. But of course, consider diversification, consider allocating some part of your portfolio to FX. Thank you.
Thank you very much, Mr. Bamidele. We'll take one more question from the Q&A session, and I will also take I will also ask two questions or a question that I feel will be beneficial to everyone on this call. So, Mr. Bamidele, this question goes to you. So, someone is asking in the Q&A session, please, why has food inflation and transportation inflation continue to increase despite our claim that inflation generally is easing? Do you want me to take that again, sir?
Caroline, I think you should take the question again, and I believe that question is directed at Afan.
Okay, so the question says, please, why has food inflation and transport inflation continue to increase despite our claim that inflation generally is easing? Mr. Afam, you can also chip in if you have contributions to these questions. Thank you.
Okay, so one thing we need to first of all understand that inflation is computed from a sample size. It's an index basically computed from a sample size representative of various commodities which are assumed to be staple commodities or even various basically commodities or activities which the average Nigerian expends his disposable income on. So sometimes people make the comment that, yeah, we're still seeing prices go up, but it's we'll call it like outlier cases whereby individuals will have various opinions, but the authorized body computing this have taken a proper sample of what is expected from the large populace. So most times you might see get comments like that. But looking at it from another leg, you find out that, like I said earlier, the core inflation has been largely or reasonably stabilized because we saw from January to in Q1, basically, it was on a steady decline. But just in May 2026, it spiked up largely because of the impact of the extended volatile components, that's food and energy inflation, into that core. But in June inflation, we saw it go down again from about 16.8% to currently 15.92%. So yes, transport costs feed directly into food prices. That's why you keep seeing food inflations high, as NBS has currently reported at 17.72% year on year in June. But what you look at largely, which also is a major component of headline inflation, is that core part. Overall, what are those things that are not easily sensitive to price changes? Let's say, for instance, healthcare, rentage, for all those other expenses with the MBS has computed it and has come to based on their parameters or measures that the price level in the underlying economy is still somewhat stable. But things we can largely relate to are largely exposed to oil price volatility, which is PMS volatility. That's why we keep seeing that food inflation is still high, but core inflation, because it's coming down, is contributing to bringing down headline inflation. So that's how we break down various components of inflation. Some may be high, but some may be low, but ultimately the trend is that it's coming downwards.
Thank you very much, Mr. Afam. Mr. Bamidele, please, do you have any addition to this question, or we should just proceed to the next question and the final question?
Well, I think Afam did a great job at expressing his views. I would just like to add that you see, when we speak of food inflation, we also have to look at it from the point of view of transportation cost or the logistics cost, which is impacted by pump price of fuel. If you have a situation in a place like the Middle East that pushes up pump price of fuel, of course, that translates into logistics cost. And of course, the food has to be shipped from farm to the consumption center. So that has an impact on that and, would be a contributor to food inflation. Thank you.
Thank you very much, Mr. Bamidele. The last question from my end is, so what advice, what trend do you think, investment trend do you think investors should look out for in the remainder of this year? What would you advise that we investors should look out for before investing?
Well, I guess I should be the one responding to this question. So, of course, before investing, we have said during our presentation, there's some advantages with fixed income instruments as we speak. So you cannot completely look away from there. Treasury bill rates have improved. So look towards that. Let's not forget about hedging. And we should also not forget that look, there are opportunities in the fixed income market. So at the end of the day, it comes to an allocation issue. You want to overweight the fixed income side of things and still have some allocation in FX, have allocations in equities. But be careful with the equities because of the trajectory the market has followed year to date. Be very selective. Do your thorough research and analysis when you're making equity investments. Thank you.
Thank you very much, Mr. Bamidele, and thank you, everyone. And as we come to the end of today's webinar, I'd like to sincerely thank our speakers for sharing their expertise and valuable insights. Also, I want to thank everyone who actively participated in this webinar. If you would like to learn more about our products and our services, you can reach out to us on our official communication lines. Our website is www.pacassetmanagement.com, and our client service email at customerservice@pacassetmanagement.com. You can check the Q&A session for the contact numbers and the link to the website. Thank you very much for joining us on this call. We appreciate you all taking your time to be with us here today. And have a wonderful day. And we look forward to seeing you at our next webinar. Thank you, everyone.
Thank you, everyone.